Good evening, ladies and gentlemen. This is Barry Norman on behalf of ETX Binary, and welcome to our class, Trend Trading. Now, ETX is a regulated provider, so I'm required to give you a risk warning, so let me read that and get that out of the way. Trading the financial markets can result in the loss of the amount invested. Do not trade with funds that you cannot afford to lose, and seek advice if you do not understand the risks. All information is provided in this webinar is for educational purposes only. ETX Capital and the presenter are not financial or investment advisors and do not recommend any securities or instruments of any kind. Now, when you trade with ETX, you can choose from trading on our binary option platform to trading CFD and Forex or spread betting if you're in the UK using our MT4 platform or our advanced web trader called ETX Trader Pro. You decide what the best way is for you to trade, what assets you want to trade, what style you want to trade, and somebody in our support department will make sure you get set up on the right platform. So let's get started talking about trading the trends. Now, first of all, you have to decide for yourself whether you believe in the trends or not. I was just reading an article today that said trends are a waste of time. But you know what the oldest adage is in the market? The trend is your friend. The fact is, most people that trade with the trends are more profitable than those who try to trade against it. And statistically, it's been shown over and over again, when an asset is in a trend, it is most likely to continue in that direction until it generates a signal that that trend is about to end. Now, some people qualify the trend as your friend to call it the trend is your friend until it's over. Well, understanding when it's over is very, very important. But trend following is perhaps the most popular long-term strategy in the financial markets. As a trading strategy, it is exceedingly effective and profitable when the conditions are favorable. Is quite straightforward in its methodology. It's not very complicated, and there are many individuals, past and present, famous and obscure, who have used this strategy to earn success and riches. Now, I'm not telling you it's going to pay you more profit than any other strategy. I'm not going to tell you it's going to make you rich overnight. I'm not going to tell you any of that because it's not true. Every strategy you use works differently for the user and works differently in each market. So statistically, just because one strategy worked very well for one trader doesn't mean it's going to work very well for another. Doesn't mean it won't work bad in tomorrow's market, but work well in today's market. So understanding what you're doing and using the proper risk management tools is always critical. We should note that the technical aspect of trend following is in fact quite simple, but it also requires that before everything else, discipline, sound money management, and patience from the trader. Trend following is not a short-term method, and patience and determination are as important as the correct analysis as a result. Trends are created by powerful underlying economic factors which may not be all that clear to those who are not very familiar with fundamental analysis. But the simple patterns created by price action in response to the economic events can often be identified through methods that are easy to learn and apply. Thus, the retail trader has as much potential of success as the most experienced analyst if he can control his emotions and behave logically. Now, to apply this strategy, we must be first aware of the existence of a trend. Without identifying a trend, we would be gambling. And that's not the purpose of trading Forex. Both fundamental and technical analysis can be employed for identifying a trend, and both of them have their advantages and drawbacks. It is in general a good idea to use a combination of them for deciding on a trend's character and deciding on our entry and exit points. Now, in order to properly identify a trend, one must understand how to draw a trend line. And we do this by number one, drawing a proper trend line. And if you're not sure how to draw a proper trend line, you should come to our class called The Trend is Your Friend. Now tonight we're going to talk about these, but we're not going to actually sit back and draw trend lines. We do that in a class that's called The Trend is Your Friend. But for trading the trends, we need to identify that a trend exists. And we can do this by general observation of the market swing points is the first point and call in determining if the market is trending. So a trend line and a trending market are different. Okay, because a market can be moving sideways but still be part of an uptrend. Okay, we don't want to see there's congestion in the market, and we want to establish whether it's a solid, strong trend or a weak trend. Okay, this isn't done with a trend line. This is done by observing the higher highs, the higher lows, the lower highs, and the lower lows. But instead you see sideways price movement with no obvious general up or down direction. Then you have nothing. Then you're probably looking at a range-bound market and one that is simply chopping back and forth. So what we're looking for is a market that is constantly making higher highs and then a higher low. In other words, this low is higher than the previous low, and the next low is higher than that previous low. Each high is higher than its previous high. These are the swing highs and swing lows, not the next step, but the next process. Okay, now, these are made by the peaks and valleys or the thrust and the ease in the marketplace. The market is pushing, easing, pushing, easing, pushing, easing, pushing, easing. And this is price movement. This is the price action that we're looking for. In an uptrend, in a downtrend, we're looking for just the opposite. Push, ease, push, ease, push, ease, push, ease. Because markets don't move in a straight direction. So if you see a trend line that's drawn like that, or a market trend that's drawn like that, you haven't looked close enough, because when you break it down to sectors, you'll see the price pushed up, eased down, pushed up, because at some given point, you have buyers in the market. Those buyers mellow out, or they get bought out, or they ease back a little bit to see where the next move is going to be. That allows for a thrust, or the initial buyers made the profit they were looking for and they're selling out of the market. Doesn't mean the market's in reverse. A lot of us set our profit and loss ratio at the very beginning, and when that trade hits our profit point, because we've set up a take profit point, it triggers that sell. Doesn't mean the buyers are running out of the marketplace. It means those initial buyers are taking their profit and sitting back, or some of them, depending on the strategy you're using, move up their stop loss, sell half of theirs at the profit, and keep the other half going to make more profit. But this is what causes these thrusts and eases. It's the momentum of the marketplace, and a well-defined trend will have these thrusts and eases. Now, the angle they're on and how steep and what tells you how strong that trend is. I mean, what we've got drawn on this picture is a beautiful trend, but the markets don't always move so picture perfect. So you shouldn't have to think too hard about whether a market is trending or not. Most traders make trend discoveries way too difficult. If you take a common sense and patient approach, it's usually fairly obvious if a market is trending or not just by looking at the raw price action of its chart from left to right. To make sure you mark the swing points on your chart as you draw your attention to them will help you see if there's a pattern of higher highs and then higher lows, lower highs and then lower lows, as we discussed before. So in an uptrend, we want to continue making higher highs. Each time the market eases down, pushes to a higher high, eases back down, pushes to a higher high, or the exact opposite. A lower high, a lower low, a lower high, a lower low, and this is a downtrend. This is an uptrend. So they're just the reverse of each other. And we can do this by general observation. We don't have to do this by just drawing lines on a chart. We can just observe. Now, once we've observed the trend, we have to then decide how we're going to analyze the trend. Now, there are many different types of analysis or many different types of tools we have. Now, I call myself a technical fundamental analyst because I use technical analysis, but I'm always aware of all the fundamental analysis that's going on in the marketplace. Because to see a technical, to use a chart and your MACD and your moving averages and your crossovers and your RSI and stochastics to make a trading decision, but not look to see that Mario Draghi is making a speech to Jackson Hole today, and he might send the euro all the way up or send the euro all the way down or just spark some volatility for a few minutes, can make you make a bad decision. At the end of the day, the asset could have ended up just where you said it was going to be. But what happens, you got stopped out because when Draghi was talking, there was so much market volatility, it went below your stop loss point. So I don't ever believe that we should be one or the other. I think we should use a combination of both. Because also using fundamental analysis, whether it's a press release, whether it's a speech by Stephen Jobs, whether it's Janet Yellen doing something, isn't going to tell you where an asset will go. It won't tell you what levels or what markets or what could cause those thrusts and eases. It won't tell you where to put your stop loss and your take profit points. It might just tell you which direction that asset might move. So you need to combine both of these to make a smart trading decision. Now, fundamental analysis can provide you with information which can predict the strength and the length of a trend, while technical analysis can show you how it develops. It is possible to base your strategy on one of these to the exclusive of the other. It is still possible to turn a profit if you are lucky enough, but our principle has always been to reduce the role of luck to as little as possible. Fundamental analysis is more reliable than technical analysis in defining a trend that has a short-term potential, but without technical analysis, it would be extremely difficult to decide when and how to trade. Now, technical analysis can suggest the beginning of a trend, but is unlikely to tell much about the length or the strength of the same. So I suggest that you use both technical and fundamental methods for your trend following strategy, with fundamental factors eliminating the false signals of technical analysis and technical tools providing you with a time price frame for deciding on entry points. So now we come to the crucial understandings. How do I decide on the existence of a trend? Now, there are many technical tools that can signal the phenomenon, but there are equal number of false signals generated by them. Remember that there are only three kinds of trends that exist at any one time: flat or congested or sideways or range. Call it whatever you want, but it's sideways movement. Then you have an uptrend and a downtrend. Now, it is possible to speak of trends between any 2 points on a price chart. Simply take two random points on a chart, draw a line, a moving average on it, and the pattern that arises can be analyzed as a trend. Thus, it is always necessary to have at least a basic understanding of the economic factors that can create the trends before deciding on the validity of a chart pattern. So we need to be able to recognize trends. Okay. And remember, we keep coming back to thrust and ease, thrust and ease. But you can have a beautiful trend that thrusts and ease, but it must make lower low, higher low, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. Thrust and ease, thrust and ease, thrust and ease. But one of the best ways to see these very clearly is using a simple moving average line, which will average out the prices and will show you a beautiful trend movement. Now, the trend that we speak seek to trade is different from random fluctuations. Range patterns and similar price movements in the price itself, in the absence of any technical indicators, can still be recognized as showing a trend. In other words, there are some driving conviction behind price action which allows the trader to easily identify it visually. Depending on the type of trend, that is, successive highs and lows should constitute a rising or falling pattern with relatively few irregularities. But such a case is often a rarity. Now, granted, we are looking at textbook, pretty perfect stuff when we're looking at class. In the reality of the markets, it isn't so clear, and especially in a fast-moving market. But you'll be surprised how often you get these beautiful trends. You might have a little wick of a candle that bounced in and out, okay? But otherwise, you will see these thrusts and eases, okay? And some people say it's very hard to find, and it is. But the fact is you should only be trading very few signals. So if you go through lots of assets and you don't see any, and then you come across one, it's pretty rare. So when you find it, that's a beautiful trend, it's telling you, you know what, maybe you should trade me. Now, if the trend can be identified visually, why use technical tools? Even though we can notice the existence of a trend, we still need technical tools to trade it and to time it. Now, there are many things we look at, but one of the most important things we're going to look at is called divergence. It gives you a strong clue about what's happening in the market. Divergence is the opposite between a trend pattern and the pattern that the indicator is making. So when we're using stochastics or RSI, which are trend indicators, when we see the trend moving to lower low and on to lower low, but our indicator is reaching from lower low to higher low, we have a divergence. If you notice, the two of them are moving against one another. Again, here we see it farther down. Here we have a lower low, a higher high, and a lower high while we're making new highs. When we see those divergences, they are giving us entry points. Okay. This was actually telling us the market was truly going to reverse itself at this point. And we got a very strong market reversal. Okay. So this is called a divergence. When your indicator, okay, and these are what we call bounded indicators. Bounded indicators are placed on your chart below your price action, and a bounded indicator like RSI, stochastics, and there's many more, are the mathematical calculations are bounded between a range of numbers. Stochastics and RSI are always between 0 and 100. When you're using MACD, okay, you're usually between 0 and -2 and +2. Okay. They're within a range, so therefore we can chart this range and look for the divergence. Too many people think divergence is the crossovers between the two indicators, but it's not. Divergence is when the indicator and the price movement is moving in the opposite direction. So that's telling you that the trend you're looking at is about to end and move into a reverse trend. So this will give you a signal. So this is how one of the reasons we use technical indicators to tell us what's going on with the trend. Because if we have been ready to trade this downtrend, we would have been making a very big error. Now, I'm sorry, let me get my markings off of here. Trending markets tend to make strong moves in the direction of the trend, followed by periods of consolidation or a counter trend retraced before the next leg of the direction of the trend. So it's also important to understand what is the difference between a reversal trend and a continuation trend. Okay. Because because price moves in thrusts and ease, what we get are retracements, because you don't want to panic when the price moves against you because you think that the price is going to move, the trend is reversing. because you've already talked yourself into believing and understanding that price moves in thrusts and eases, is determining how these thrusts and eases are. Is it really a thrust and an ease, or is it a thrust and an end? So there are other ways to look at these. We use these with moving averages. And when we have a crossover of the moving average during the thrust or the ease point, we could then see an entry and exit point. So in other words, here we would have made our first trade at this point. We would have exited that trade at this point. When it retraced again and the moving average, we would have traded again going down and exited at this point going down. And we would have been using a moving average line, and every time the moving average, the price crossed the moving average, we would be entering or exiting the market. So you need to learn to identify the different parts of a trend. This will help you avoid over trading during the choppy consolidation periods, and will give you a better chance of profiting when the trend makes a strong move. So in other words, we're going to talk about it again. Thrust, ease, thrust, ease, thrust, ease, thrust, ease, thrust, ease. If you get yourself to believe this and understand that these are retracements and not reversals, okay, and this is just the breather that the buyers or the sellers are taking in between. Now, it can very easily turn into a reversal, but there are true reversal signals that you'll see. So here we can see an uptrending market, which consists of strong upward moves followed by periods of consolidation and shallow retraces lower before the uptrend resumes. Okay. Now, it's very important to understand these and not panic when you see them. And again, if you understand that a well-formed trend moves this way, and if you ever see a trend moving that way, get out of it because there's something not right. You need to see this, and when you got yourself convinced that this is the proper movement of a trend, you won't panic when the trend eases. Because when you panic when the trend eases, you tend to lead the market before you really get profitable. Now, there are ways to eliminate your guessing, okay, by using a combination of your trend lines, your thrusts and your eases, and something called support and resistance. We can see that a trading market tends to move in spurts, moving in the direction of the trend and stalling to take a breath before another leg in the direction of the trend. Now, all the trends are obviously not exactly the same, and we do not typically see the general pattern described above. A forceful move in the direction of a trend followed by a period of consolidation, or the retracement in the opposite direction. You know, again, like I told you, for my drawings, they're very plain and simple. But in the reality, you'll still see them, but they're not as clean cut. But if you actually can draw these thrusts and ease on there by attaching your swing lows and swing highs, you'll see that when you lift the price off of, what you're left behind is pretty much the pattern that you would talk about. When you draw a proper trend line, that will also help you see that, because by always having higher lows and higher highs in an uptrend, guess what? You never break the trend line. When that trend line gets broken, it's telling you the market was most likely getting to reverse itself. And what did we see here? We saw it thrust, but we saw it ease back up, but that was the end of it. And then we saw it move into a downtrend. Again here, if we would have taken just our swing high, or swing low, or swing low, or swing high, or swing low, or swing high, or swing low, and then drawn but then what happens? We went into this messy consolidation. So again, we have that buyers have one last thrust, but that was telling us the markets are about to end, or that trend is about to end. Now, again, we'll talk about what these retracements are and how you will calculate. Now, these retracements are when we have the highest potential for a high probability entry point within a trend. Now, the retracement is when you would like to enter the market. Okay, because you don't want to enter the market at the top. You want to enter it when it's come down here and retracing so you can take advantage of that thrust. And then when it retraces the next time, it's going to still be higher than your entry point. And then you'll keep taking note. And every time you have a thrust and an ease, okay, you would look to get in at the, not at the bottom, but when it bounces off to end that retracement. And you do this using support and resistance. Once the market will trace to approximately the level of its previous swing point before the trend resumes. In an uptrend, these swing points are support, and in downtrends, they are resistance. Look at the first diagram for a quick refresher on what I'm talking about. So let's look at the chart we just looked at, but this time with the support levels marked. These support levels result after the market began to retrace lower within the structure of the broader uptrend. So what we can see is these retracement levels, these support and resistance levels already on our charts. Okay. So this is what we would expect, because when the market is pushing or thrusting upward, there's a point in which the buyers, like I said, they already put their take profit points, they're going to sell half their investment, they're going to do whatever, or the buyers are going to just sit back and wait for a second. These are, because you're going to predict them ahead of time, these are usually used by looking at resistance or support lines. Now, there are many ways to get these support and resistance lines, but my best, and if you come to our class on support and resistance, is called eyeballing. What you want to do is look at a recent chart over a period of time in the same basic time frame you're looking at, but you want to see where the asset has reacted in the future, in the past, to the prices around the price where it currently is trading. In other words, if the euro is at 119.01, we want to take a little bit, when the euro was around 119.01 yesterday, did it break through? Did it push down? Where did the buyers hem and haw? Where do we see lines of congestion? Where do we see lines of indecision? And we would look back in past charts to see what prices were critical whenever that asset was trading in that range, and draw those lines forward. And those will give you levels of support and resistance using the eyeballing method. Now, market timing is also very critical. Market timing never works out the way we predict it. Reversal points don't happen on a clock. However, market timing in the context of a trend, with the purpose of picking the counter trend extremes and using them as a trade, is necessary and profitable. And there lies a main principle of trend following strategy: recognizing the trend, identifying the counter trend moves, and then use them to enter a trade in the direction of the trend. In other words, as close as you can to the bottom of that retracement. So the best tool for trend following is applied by moving averages and simple price charts. Bar charts, candlestick charts, and many others can be equally useful if employed with moving averages. It is also possible to use moving average crossovers and a myriad of other methods, but whichever you choose to use, you should ensure that you do not complicate the main aspect of your strategy, which is trend following. So MACD, moving average convergence and divergence, is one of the most popular. But a simple moving average makes a great trend following tool. So if you want to trade on a weekly or daily basis, the 100-day moving average will probably be able to best capture the most important trends for you. Anything with a longer period is likely to be meaningless because too much data is discarded. Now, one of the best trading methods I have seen for trend following is using 3 easy lines. It's using a 30-day, a 60-day, and a 100-day moving average. Okay. The 30-day moving average is a shorter moving average, so it's going to be more responsive because you're using the more current time period. The 60-day is a longer time period, so it's less responsive. When the 60-day and the 30-day cross over, it will give you a buy or a sell indicator. And it works extremely well. And then you combine that with the 100-day moving average to verify that you have a trend. And when price breaks through, or the moving average touches the price, and you also have a breakthrough of the two indicators, you can then have a solid, good trending method. Now, in this case, what you're seeing on the chart here is we're only using two moving averages, which works also extremely well. So this is a simple moving average, and our blue line is a simple moving average. What we're looking for is when the short-term moving average and the long-term moving average cross over one another. Okay, and in this case, they crossed over at the bottom of the candle, so we would be trading an uptrend. Here, we'd be exiting the market. Okay, we have a crossover. Here we have, now, the reason you would combine this with the 100, because they can give you false signals. In this case, we're combining with RSI. And each time RSI breaks them out of its under 30 motion, because under 30s tell you market's overbought or oversold, okay, we are following that. But this is a very simple strategy. So here, we can start out with all the way up here. Let's start with entry number 13, which is a nice clean one right here. We have the end of a major downtrend, the doji and the cross candles if you're using candles, and then we have the large green candle with a breach, and we have RSI in an oversold area. But we also have the two moving averages crossing. Two moving averages crossing. Okay. It's a simple strategy with getting all that other stuff out of it. Okay. Now, the most important and critical part comes is where do you put your stop losses and your take profit points? This partly depends on the term and the nature of your trend following method. A stop loss order can be placed a short distance above or below the trend line. Whether it is provided by moving averages or a simple line drawn on a chart. In our opinion, the trend follower should not realize his profits until he has a good reason to do so. The purpose of the strategy is to focus on underlying price dynamics by stripping out volatility and short-term movement. And there's a little logic to realize profit in response to fluctuations which are irrelevant in the main action of a trend. But first you have to have a risk management strategy. Now, I always emphasize a 3-to-1. So in other words, if you're expecting a 20-point drop, if you have to put your stop loss 20 points down, because that's the swing of the marketplace, you need to be able to realize a 60-point profit. If you can't generate a 60-point profit, if that can't be your target point, then you can't make that trade. That will stop you from getting involved in false signals or low profitability trades. So in other words, in order to cover the volatility of the market, say in gold, and gold might, you're expecting gold to trading at 1250 to fall as low as 1225 because that's the lowest candle in the thrust up and thrust down, and that's 25 points down. In other words, that's $2,500 in loss you might expect if you were trading, a contract of 100. Then you have to be able to realize a profit of $7,500 if you're going to make that trade. This is before you decide to make the trade. If you can't put your target point at something that's 75 points up to cover that 25-point swing down, you just can't make the trade. So you walk off and go on to something else. So this trading method involves a risk management component that uses three elements: the number of shares or contracts held, the current market price, and the current market volatility. An initial risk rule determines position size at time of entry. Exactly how much to buy or sell is based on the size of the trading account and the volatility of the issue. Changes in price may lead to a gradual reduction or an increase in the initial trade. On the other hand, adverse price movements may lead to an exit of the entire trade. Okay, now someone just typed in a question to me, and if you don't know how, and the question is, how would you determine what the potential profit will be in a trade? You can never determine what the potential profit is. You can set a target point. You could say, okay, If I need to be able to have 25 points down, I need to have 75 points up. Now, when you look at there's many different types of ways you calculate it. There's parts of a triangle that you can use. You can use the last swing high. You can look at where the next resistance level is. But you have to determine your target. That's where you would put your take profit point before you ever enter a trade. And if you don't know how to determine the potential profit, then you cannot be making a trade. You shouldn't even be trading it. So first, that's part of your strategy. Is when, not in this class, as part of your overall building a trading plan, is what formulas do I use to determine where a target price might be. Now, you can get these from chart patterns. You can get them from support and resistance. You have to make that determination, okay? And you have to understand what you're looking at on a chart. If you can't do that, if you don't understand candlesticks will also give them to you. But you have to understand them. And if you don't, you need to come to classes to learn how to come up with these targets, okay? And these targets, the profit and loss and the risk scenario and your profit potential are more critical than making a solid trading decision. Okay, period, the end. If you understand risk management and money management, and you have a good trading plan, not a strategy, you'll find out you'll be successful. Because it's continually about understanding your risk, and your risk is based on where you got to put your stop loss and where your profits got to be to cover that. And can I afford, or can I make this trade? Because it'll stop you from making all the bad trades. And when you do make a trade and it goes wrong, you don't lose your shirt. And when you do make a trade that goes right, you make enough profit at a 3-to-1 loss profit ratio. At least if you're right every third trade, you can cover all of your losses. Okay. So price. One of the first rules in trend following is price is the main concern. Traders may use other indicators showing where price may go next and what it should be, but as a general rule, these should be disregarded. A trader need only be worried about what the market is doing, not what the market might do. The current price and only the price tells you what the price or the market is doing right now. And since none of us are long-term investors, we're concerned with what is happening now, because you're going to trade now. Now, money management is another decisive factor of trend following. Is not the timing of a trade or other indicators, but rather the decision of how much to trade over the course of the trend. Risk control, cut losses is the rule. This means that during periods of high market volatility, the trading size should be reduced. During losing periods, positions are reduced and trade sizes are cut back. The main objective is to preserve your capital until a more positive price trend reappears, not to lose all of your capital because you've made poor trades. Trend following should be very systematic. Price and time are pivotal at all times. This technique is not based on the analysis of fundamental supply and demand factors. So let's get a little bit more detailed. In Forex, bearish and bullish trends are typically equally as violent and potent, whereas in equity markets, we tend to see slower moving price action in a bull market, along with lower volatility. Downtrending markets tend to be fast and volatile in equity markets. In other words, if you're looking at equities, it takes a lot to push a stock up. It doesn't take a lot for it to tumble. Forex trends tend to be the same in their volatility and price action, whether the trend is up or down. The main reason is because it's one currency against another at any given pair, and this results in more balanced price movement. So what does that say to you? When you're trading in Forex, most likely the next ensuing uptrend will be possibly as steep as the previous downtrend. So note in the chart over here that how the down and the uptrend were about the same in their volatility and price action. Now, the simple rules presented here are good enough to replicate the performance of many large name trend following hedge funds, which with high precision and correlation. In my book, I detailed several ways that this can be further enhanced and moved upon. Make no mistake though, the trend or trading system rules is the least important component of your trend following strategy. Position size. Some markets are inherently more volatile than others. To give each position an equal chance to impact the bottom line, positions must be larger for less volatile markets. This can be achieved in many different ways. My core strategy uses ATR, which measures the true range of the current market. ATR measures the average daily price movement of the market. Okay. Then we use trend filters. Long positions are only allowed to be opened if a 50-day moving average is above the 100-day moving average or vice versa. This is to ensure that we don't put on trades counter to the dominant trend. It reduces the number of trades and lessens the risk of the market getting caught in a whipsaw. Entry signals. Enter long positions on a new 50-day high. Vice versa on shorts. Go with the breakout and ride the trend. Always trade with the trend, nothing else. Signals are generated on daily closing data and the trade taken on the following day. Slippage is accounted for, of course, as well as the trading costs. Now, keep in mind the old adage, the trend is your friend until it ends. Okay. So this one line pretty much sums up the quandary that traders are faced with when trading trends. While a bias has been exhibited in the marketplace and may continue, there is no such thing as a surefire trend continuation setup. So when the trend doesn't continue, the trader is often advised to look to mitigate losses so that a reversal doesn't damage their trading account too badly. In an effort to be as precise as possible, many traders will move down to a lower time frame in an effort to get a more detailed look at the moves inside the larger term period. So in other words, look at longer term trends as well as shorter term trends. What I look for is the minute my lower low or my lower high is violated, I get out of the market because I no longer have a retracement. I'm then having something else. It could retrace, but I'm having something that doesn't fit my pattern. So I get out of the market. Okay, I'll take my few points. I'll even take a small loss, but I just say I'm out of the market until I figure out what's happening. So price action can help traders diagnose and trade the trends. Traders can also look to indicators. There are numerous indicator options for this premise. Many traders will look to oscillators such as RSI and MACD to trigger a position. Other options are MACD stochastics, the CCI, and the moving average crossover. Traders looking to speculate with the trend want to focus only on signals that move in that direction. So in other words, you will get lots of signals that will give you a trade against a trend. Throw them out the door before you get started. Exits. Exit on 3 average true range moves against the position from its peak reading. Thereby, we have a theoretical loss of 60 basis points. No intraday stops are used, and so a close beyond 3 ATR units are needed for a stop to be triggered for the following day. Now, this doesn't fit for most of us, and most of us aren't holding positions over to the following day. So, again, instead of using ATR, I use my lower lows or my lower highs as well as my moving average crossovers. And if I get a break in my trend line. Now remember, trading a trend following systems on a single market or on a few different markets is suicidal. There may be long periods, even years, when there are simply no trends in any given market or asset class. Now that's very rare. The key idea is that to trade many markets covering all asset classes at the same time. If you fail to do so, this strategy will simply not work. The investment universe will you choose will have much greater impact than tweaking buy and sell rules. So choose wisely. You should choose a broad set of markets to avoid high concentration in a single sector. Now, trends develop for a reason. Perhaps due to a shift in the economy's fundamentals, trends show a bias that has existed on the chart. While the future is opaque and unpredictable, this bias may continue, and that is why so many traders look to trade the trend. After all, the future is unknown and nobody has a crystal ball that will magically foretell tomorrow's price movements. But the fact of the matter is that biases do exist. Trends do take place and for a reason, and in many cases those trends may continue. The types of strategies are endless. But let's look at very quickly a simple Forex strategy. The simplest trend following strategy uses moving averages, and it's my favorite. This variation which can exhibit are many. They can use 1, 2, or even 3 moving averages, and like I explained to you, 30-day, 60-day, 100-day. Okay. The trading rules can also be complex with different weights applied to portfolio components. However, models which have a great many floating parameters can easily be over-optimized until back-tested. So I use basically a simple moving average using a 30, 60, and 100. You can use an exponential or a weighted moving average, but they all become more burdensome, and I don't find give us enough differential when we're using 3 strategies, 3 moving averages. Such strategies seldom survive the actual test of trading. If its currency pair cannot be traded successfully within a simple trend following strategy, it's unlikely to be realistically improved on by adding levels of complexity. The currencies which we tested were based on the Indian index without some of the more minor elements. As you can see here, a number of currencies exhibiting satisfactory trend following behavior, but others definitely do not. So we can take a look, and this is just, I didn't do this test, but it was conducted by a leading agency. And we can see through here a whole bunch of assets that trade very successfully using a single moving average. Okay. We can see the annual rate of return, and we can see one of the most popular and most successful is the USD JPY, the US dollar Swiss franc, the Euro US dollar, the GBP JPY. Okay, there are many of these that have very good success rates. Okay, thus it's relatively easy to select those currencies which are sufficiently trend following to include in your trading portfolio. Strategy with 2 moving averages are popular, and when optimized without costs almost inevitably provide better back-tested returns. So again, we still come out with the USD JPY, the Euro CHF, the GBP JPY, and the Euro SEK, but we don't have that available in most trading. Okay. Now, it is often possible to improve the returns of a trend following strategy by adjusting the face value of the trades according to the volatility of the underlying market. Now, this gets a little bit complex because we go back and add a volatility adjustment. So in other words, when the markets are extremely volatile, we wouldn't be trading, so we would take those trades out of the marketplace. Okay. Now, according to ensure that we are not faced with too many variables which could be optimized to produce a good backtest result, we varied a single optimization parameter, which was the level of distribution of historical volatility. And this is all just what was conducted in the test. And we can see that, again, the success rate of the USD JPY using a single moving average was overall the most successful of all the assets out there, even when we used it with a volatility adjustment. So remember, find a strategy, own it, keep it simple, and just get it done. Thank you very much for joining us tonight. I hope I gave you some food for thought, and we'll talk to you again real soon. Have a great trading week, and thank you for being part of ETX. Good night now. This class has been recorded. To go back and see the recorded version, just simply click on the link that you used to attend tonight's class, but give it about 24 hours to be there. Thank you very much and have a great week. Good night now.